So let's talk about something called liquidity. It sounds complicated, but I promise it's really simple. Imagine you open a lemonade stand on your street. If your street is super busy, with tons of people walking by all day, you have a lot of potential customers. Whenever you want to sell a cup of lemonade, someone is right there, ready to buy it from you. You can sell your lemonade quickly for the price you want. This is what we call high liquidity. It's the ability to buy or sell something fast without the price changing too much. It's all about having a lot of people ready to trade at any given moment. Now let's picture the opposite scenario. What if you set up your lemonade stand on a very quiet, empty street? Maybe only 1 or 2 people walk by the entire day. When you want to sell a cup of lemonade, you might have to wait a very long time for a buyer to show up. And when someone finally does, they might not want to pay your price. You might have to sell it for much cheaper just to make a sale. This is what we call low liquidity. There aren't many buyers or sellers around, which makes it hard to trade quickly and at a fair price. It introduces a lot of waiting and uncertainty into the mix. In the world of cryptocurrency, the lemonade is the coin you want to trade, like Bitcoin or some smaller altcoin. The busy street is a crypto exchange with lots of traders, and the quiet street is an exchange with very few active users. When a cryptocurrency has high liquidity, it means there are thousands of people on an exchange ready to buy it, and thousands ready to sell it at any second. This constant activity makes the whole process smooth and efficient. You can get in and out of a trade almost instantly, just like selling lemonade on a bustling city corner where customers are lining up. The core idea is simple. Liquidity is all about how easily you can convert your crypto back into cash or into another crypto without causing a big price drop. A liquid asset is like cash itself. You can use it or exchange it easily. An illiquid asset is more like a rare, collectible piece of art. It might be valuable, but finding the right buyer at the right price can take a very long time. For anyone looking to trade, understanding this difference is the first step to making smarter decisions and protecting your money from unnecessary risks. Without a doubt, it's one of the most important concepts to grasp. When a cryptocurrency has high liquidity, it's like shopping at a huge, popular supermarket. There are countless buyers and sellers all gathered in one place all at the same time. Let's say you want to sell your Bitcoin. In a high liquidity market, there are thousands of people who want to buy it from you right this second. You can execute your trade almost instantly. You don't have to wait around, hoping someone will eventually notice your sell order. This speed and efficiency are huge advantages because they allow you to react to market news or changes in your strategy without any delay, which is absolutely key. Another massive benefit of high liquidity is price stability. Because there are so many orders to buy and sell, the price of the crypto doesn't jump around wildly. Think about our supermarket example again. If one person decides they want to buy all the apples, it won't really affect the price because the store has a massive stock room full of more apples. In the same way, one large trade in a liquid crypto market won't cause a huge price swing. The price moves more smoothly and predictably, which is fantastic for traders because it reduces the risk of sudden, unexpected losses caused by a single transaction. This stability leads to something called a tight spread. The spread is just the small difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. In a liquid market, this gap is tiny, sometimes just a fraction of a cent. For you, this means you're getting a very fair price whether you are buying or selling. You aren't losing much money just on the transaction itself. It's like the supermarket selling you an apple for $1 while offering to buy it back from you for 99 cents. The difference is minimal, so you know you're not getting ripped off. Finally, high liquidity makes a market much harder to manipulate. When there are billions of dollars worth of trades happening every day, it's incredibly difficult for one person or a small group, often called whales, to move the price in their favor. It would take an enormous amount of money to make even a small dent in the price of something as liquid as Bitcoin. This protects smaller investors like us from being at the mercy of big players trying to unfairly influence the market. It creates a more level playing field, where price is driven by genuine supply and demand from everyone involved. Now let's explore the other side of the coin. Low liquidity. Trading a crypto with low liquidity is like trying to sell something at a small, dusty corner store in the middle of nowhere. There are very few people around. If you want to sell your obscure altcoin, you might find that there are only a handful of buyers interested, and none of them are in a hurry. You could be waiting for hours or even days for your trade to go through. This slowness is a major problem, especially in a fast-moving market where prices can change in a matter of minutes. You could miss your chance to sell at a good price. The biggest issue with low liquidity is extreme price volatility. Since there are so few buyers and sellers, even a small trade can cause a massive price swing. Imagine our corner store only has 3 rare action figures for sale. If someone suddenly walks in and buys all 3, the item is now sold out, and its perceived value skyrockets. In crypto, this is called slippage. You might place an order to buy a coin at $10, but by the time your order is filled, the price has jumped to $12 because of your own purchase. This makes trading unpredictable and very risky. Low liquidity also leads to a wide spread. Remember, the spread is the gap between the buying price and the selling price. In an illiquid market, this gap can be huge. The highest price a buyer is willing to pay might be $9, while the lowest price a seller is willing to accept is $11. This $2 difference means you immediately lose money just by making a trade. If you buy the coin for $11, its market value is instantly just $9. It's like a pawn shop offering you $50 for an item that they plan to sell for $150. The wide spread is where market makers make their profit, but it comes directly at your expense. Furthermore, markets with low liquidity are very easy to manipulate. A single wealthy trader, or a whale, can single-handedly cause the price to crash or pump. All they have to do is place one large buy or sell order, and because there aren't enough other orders to absorb it, the price will move dramatically in their favor. They can essentially create their own price movements, often tricking smaller investors into buying high or selling low. This makes trading in low liquidity coins feel like walking through a minefield. The risks are high, and the game can feel rigged against you. So, after looking at both sides, it becomes incredibly clear why liquidity is one of the most important things to check before you even think about buying or selling a cryptocurrency. Your trading experience and the level of risk you take on are directly tied to it. With a high liquidity coin like Bitcoin or Ethereum, you can trade with confidence. You know you can enter or exit your position quickly at a fair price, and without worrying that your own trade will accidentally cause the price to spike. It provides a much safer and more predictable environment for your money. On the other hand, venturing into a low liquidity coin is a completely different ballgame. It's a high-risk, high-stress environment. You might be attracted by the potential for a small coin to suddenly jump 100 times in value, but you have to remember that it can also drop to zero just as quickly. The wide spreads will eat into your potential profits with every trade, and the constant threat of slippage means the price you see might not be the price you get. It's a speculative playground where the odds are often stacked against the average retail investor trying to make a smart decision. Before you invest in any crypto, especially smaller, lesser-known altcoins, do your homework. Go to a site like CoinMarketCap or CoinGecko and look up the 24-hour trading volume for that coin. A high trading volume, we're talking millions or even billions of dollars, is a great indicator of strong liquidity. It shows that many people are actively trading it. Also, check the exchanges it's listed on. If it's only available on 1 or 2 small obscure exchanges, that's a major red flag for low liquidity. Stick to coins that are traded heavily across multiple large, reputable platforms. In conclusion, think of liquidity as the foundation of a stable market. Without it, everything becomes shaky and unreliable. While the allure of finding a hidden gem is strong, the risks associated with illiquid assets are often not worth the potential reward for most people. By prioritizing coins with high liquidity, you are making a conscious decision to reduce your risk, ensure fair pricing, and protect yourself from manipulation. It's a simple step, but it's one of the smartest moves you can make as an investor in the crypto space. So please, for the sake of your wallet, always check the liquidity first.